Hello, folks, and welcome to our February Roundtable. Appreciate our panelists joining us today. We periodically do these roundtables to try to answer the most commonly asked questions that we hear from our friends and family and clients, so that we can try to provide a little perspective on some of those issues. We may not have all the right answers, but we've been around this a little bit, and we watch the news and the screens a lot. So hopefully we can give you a little bit of insights as to some of the things that we're seeing. We'll each take a different question and kind of go from there. Tyler Morrow, do you want to kind of take the first question from here in our Knoxville office?
Sure. So one of the questions that I've been getting a lot is, where do interest rates actually go from here? And I feel like we've been asking ourselves this for the past year. But I think that the good news is we're definitely a lot further along in this process than where we were a year ago. We've gone from a number like a 75 basis point hikes to now down to a 25 basis point hike here at the last Fed meeting here earlier this month. So this is starting to signal that the Fed is reaching an interest rate range that they consider to be restrictive, for the economy and growth. So, and this will definitely help bring inflation back down to a normal level. This isn't to say that the Fed is done raising rates, and based on their recent, commentary from their last few meetings, and based on what we're seeing for inflation in the most recent readings here over the last few weeks, I think it's still likely that we see a few more rate increases there. They're due to meet again here in March, around, I think it's the 14th and 15th, and again in May. So I think it's very likely we see a few more rate increases at each of those meetings. And this would put the Fed funds rate at that point at a little above 5%, and at a range of 5 to 5.25%. And this is assuming that they continue with a 25 basis point increase at each of those meetings. And is it possible that we see a rate hike above that level? Again, right? I would say not at the moment anyway. I'm not going to say that it's definitely out of the realm, of it being a possibility, just because I didn't think a 75 basis point rate hike would be, even in the realm like a possibility here last year. So I think if inflation spikes, or if it becomes more entrenched than what it already has been, then I think we can maybe see like a 50 basis point hike, but I don't think it's likely at this point. But the Fed has made one thing, I'm apparent in each of their meetings, is that they are, they're fully committed to bringing down inflation, back to, the 2% range, I think is the number that they, continue to use. And, they're going to do whatever is necessary in order to get that done. And, Powell at the last meeting, he reiterated that they're going to continue to use, some of the current market data and reports as a basis for their decisions. So, all we can really do is, continue to watch those same reports and data, and that will really give us, a really good indication as to what they're likely, to do here in the March meeting and again in May. So I know it sounds like, hey, it's just like a lot of the same of what we have been doing, but we're definitely a lot, further along in the process than what we were here, at the end of last year to at the middle part of last year too. So the good news is that, hopefully the end is near as far as rate hikes go.
Yeah, a lot's happened in the last year with the interest rates for sure.
Right.
Thank you, Tyler. Mike, also in our Knoxville office, do you want to respond to a question that you've been hearing?
Absolutely. And the question I've been getting most often is very closely related to what Tyler was talking about. And just on a side note, I've decided that until the Fed stops raising interest rates, I'm not going to shave. So this could be an interesting year this year. We'll see how it goes, unless these guys hold me down and get the razor to me. I'm gonna hold out for them stopping interest rate increases. So anyway, moving right along. I get the question generally is a recession coming, which kind of begs the second question, or the part B to that is what is a recession? And I was reading an article the other day that really kind of brought it home for me, and it was generally discussing the 5 things that we needed to know about recessions. And I guess specifically addressing the question, what is a recession? We've been in the financial media and certainly around our office and in talking to my clients, we've been going back and forth on what really constitutes a recession. And it's a prolonged period or pattern of decline resulting in a shrinking economy. And more specifically, it's 2 consecutive quarters of GDP non-growth, or GDP stagnation, or GDP decrease. That's one way to look at it, kind of a very technical perspective, but more generally and more related to the current situation that we're in economically, is that it could be defined as a decline in economic activity spread across the economy and lasting for more than a few months. We've had some conflicting indicators on this as we've gone through it. And you might ask, secondly, what are some of the warning signs that we might be in a recession, or that we are in fact in a recession? And really has to do with 3 groups: consumers, employees or employment, and production, are the companies that make the goods or produce the services that we buy in our economy. And we can tell that if consumers are pulling back on what they're purchasing from retail stores, particularly, that's one indicator. And as far as employment goes, there's 2 pieces to that. There's the creation of new jobs, and there's the unemployment rate. And if we happen to see most recently that job creation was pretty strong, and unemployment kind of stayed around that, I won't say historically low, because we could argue through that, but certainly a very low unemployment rate. And production, it appears that companies are producing less. Usually when you see building inventory, that means that the demand is not there. But worse than building inventory is the fact that companies are just cutting back on production and expansion, certainly, of existing operations. And um, it's also a little confusing when you equate the markets to the economy. And a question I've been getting is, are recessions the same as a bear market? And the short answer to that is no. And because markets are forward looking, they operate off future expectations. You might call them a leading indicator of what we might see in the economy. If you'll remember, last year we had 3 pretty dismal quarters, and then fourth quarter things kind of started to turn around, and they've continued that generally at a rather slower pace, but they've continued that generally this quarter. And I think we're probably yet to see the worst of the economic downturn. And that sounds dire, and I don't mean for it to, because I think it's going to be relatively short in duration. And of course, the age-old question: okay, well, that's great. Well, what should I do if we are in a recession? And it's a pretty simple answer to that. And because everyone's financial situation is a little different, we as advisors are tasked with not only knowing what options and alternatives there are out there, but knowing you and your family and your um, specific financial goals. So basically, that the answer to that question is just talk to your advisor. Call us, email us, come by and see us. And we'll go through it specifically because there are no general answers to that. Those answers are very specific. And finally, the question is, what comes after a recession? Well, I have been hung with a title in our office of being the eternal optimist, and I'll continue to be that way. And along those lines, I believe that no one likes rain, but after every rain, the flowers come up and they bud. So we're looking for a flowering of the market coming up here throughout this year. We have a rare opportunity that we haven't seen in recent past. It's a chance for us to, the market to kind of get its legs back underneath it. We're not in an election year. We won't have to suffer through all the campaign slogans and all that and commercials and whatnot. We can just let the market do what it does. And generally, the market, if left alone and not facing too many headwinds, will generally go up. Guys, as you know, I've got another 3 or 4 pages of specific statistics that I'd like to go through, but I'll spare you. And if you want all those specific metrics and indicators and my theory about what each and every one of those means, certainly give us a call. We'll go through that with you. But basically the advice going forward is fear not the recession, because it too shall pass. So, Roger, I think that's probably a good spot for me to stop, and let's move on to somebody else.
Well, we'll look forward to maybe the next roundtable. You might look more like a biker if you're letting your beard grow out, right? We'll see what.
Right.
We shall see. Likely not, but we'll see.
We'll put a call into the Fed to see if he can stop that. So,
thank you very much.
So Nick from our Chattanooga office, what question are you hearing from your folks?
Absolutely. Well, I hate to be the storm cloud to rain on Mike's optimism, but this is a concern that I've gotten from a number of clients. And I think a lot of it is due to the U.S. hitting the debt ceiling again on January the 19th, and with no shortage of media attention drawn to that. But what does that mean? What is the debt ceiling? So the debt ceiling is the limit that Congress imposes on how much national debt the federal government can carry at any given time. Currently, the debt ceiling is a little over $31 trillion. One way you could think of it is you could think of a family that's maxed out their credit cards. That's kind of the point we're at as a nation. Now, we've been here before. We've raised the debt ceiling in the past, and at the current state, Treasury Secretary Yellen, she's got the ability to shuffle things around on the balance sheet to keep the lights on. So if nothing happens and we don't raise the debt ceiling, it's anticipated that we would go into default sometime in the summer. So that gives you a little bit of context into what the debt ceiling is and where we are currently. Every other time that this has happened, we have eventually raised the debt ceiling. And what would happen if we didn't and the U.S. defaulted? So that's another concern, and that would be a precedent that we've never seen before. But it's something that we would all want to avoid. If you think of the United States debt, the Treasury is often considered to be the risk-free return. You put your money in U.S. Treasury bonds and you've got a guaranteed return on your investment. So all other investments are kind of measured against the return of our risk-free Treasury bonds. So if we were to default, then that obviously brings into question how safe our debt is, and if we're going to be considered the risk-free asset. Around the world, we've always been considered to be a safe haven for investors. in our bonds, particularly because we've got a strong economy. We tended to have a strong economy, and we've tended to have a stable form of government. But if we were to default, that would call into question a lot of those thoughts across the globe. If you really think about it, it makes sense. You know, our economic activity at its simplest level is based on trust. And if we look at how Amazon became one of the largest retailers, it's because you could go to Amazon and you could find products at a fair price, and you had a good likelihood that you're going to get them when they said you would receive them. So they delivered on their promise to consumers, and that kind of trust is really critical in an economy, especially in a global economy where we're selling our debt and borrowing money from other countries. It's really important that we meet those obligations that we say that we're going to pay on our debt. So it obviously would not be very good for economic activity. We could see things start to dry up. Not only would it affect interest rates here in the United States, but with our own debt, but it would also affect all of our consumers. If the United States is perceived to be less safe, then interest rates for consumers could start to go up. You know, the very insurance that guarantees our bank deposits, the FDIC, is backed by a government obligation. So it calls all these things into question. So as you can see, the good news is we've got a lot of reasons for that not to happen. It is not in any American's interest for the U.S. to default on their debt. And at some point, we're likely to see the debt ceiling get increased, and we can continue to move forward and not have this looming over the economy. Now, that's not to say that there may be some good faith arguments coming from elected officials that may be using the debt ceiling to try to create less debt in the future, or to try to reach a balanced budget at some point. But for us to actually default on our debt, I would say is highly unlikely. It's not impossible, but it's highly unlikely. And if it did happen, the repercussions would be very bad. But I think you can see that we've got trillions of reasons for this not to happen, because our economy is really backed in large degree by the U.S.'s strength, its view as being a safe haven in the world. And I'll kind of finish things out with Winston Churchill, one of his quotes, and I think it kind of fits in this case. You can always count on Americans to do the right thing after they've tried everything else. So at the end of the day, we tend to do the right thing, but sometimes we have conflict over it. We've had civil wars, we've had things that have happened, but we tend to get in a good place as far as the country is concerned, and we continue to progress and be a leader in the world.
Thank you, Nick. Appreciate that. And I do think it's something that's going to have to be dealt with at some point. You know, we can't continue to just increase our debt and, as everybody says, push that can down the road, because even if we keep pushing it off, some of our future generations will have to deal with that at some point.
Absolutely.
Yeah, thank you for that. And I guess, kind of wrapping up a little bit, I think the question I hear the most is folks saying, okay, where do we go from here from a planning and an investment perspective? Because all these things do impact what a financial plan looks like as folks are planning for retirement or for college. And, how do we invest the money? And with the interest rates change, there's just a lot going on that changes all of that. And I think most importantly, we need to be prepared to deal with the volatility. And it's volatility levels that we haven't seen probably since 2008 and 2009. And I do not think we'll see volatility like that right? But it's a new level of volatility that people who've only been investing for the last 10 years have probably never seen. And that volatility will be caused by the things we've been talking about. You know, with Tyler, we was talking about the interest rates that cause volatility. You know, Mike was talking about a recession. Those recession fears up or down, or the recession realities will cause volatility. The debt ceiling, that, you know, that by itself can cause some volatility. Not to mention the you know, geopolitical issues that are going on, which we're hearing about all day, every day, especially now. The other thing that I think that is shifting a little bit is now we're having the impact of all these interest rate changings is affecting the earnings. And as the earnings reports come out, those are the fundamental reasons that drive the stock prices. Those too will, as those earnings are affected by all these other things, that will affect the volatility. So I think every market cycle, in my experience, there's nothing normal about any one of them. There's always a few outliers that make the market volatility something new that we've never thought about. But if you think of it in a bigger picture perspective, the market volatility is, I don't want to say normal, but it is part of the cycle, right? It's part of fixing some of the problems, getting the valuations back to more realistic valuations, and focusing on the profitabilities of these companies. So, you know, are there opportunities for us to look at? Sure. You know, the good news is now we can find bonds that are paying 5.5% and 6%. We haven't been able to buy those for 10 years. So there are some opportunities that we can try to focus on that are beneficial from an investment perspective. But there are also risks that we need to make sure we're addressing from a financial planning perspective. And those risks really pertain to each client individually and separately, and they're all different for everybody. So more than anything, I just encourage you to call your advisor, whoever that may be, and revisit those planning things, because a lot's changed, right? The assumptions have changed, the values have changed, the timelines have changed. But at the end of the day, I still feel, I'll go back to Mike being the optimist. I still believe that maybe it's 1, 2, 3, 5 years from now, longer term, I do think the market and the economy will be in a better place than it is now, which is why we invest in the market, for those long-term returns. Where some of the traps are, I think, is people chasing these short-term rallies, thinking that we're out of the woods when it's just volatility. Maybe it's going up, maybe it's going down. We don't know what it's going to look like over a 3, 6, 12-month period. Again, I think longer term, I think things will be better than they are today. As you know, today they're better than they were at some points in last year. So there are all these statistics that can show whether we're good or bad or doing better or worse. But I think if we keep the longer term perspective in mind and relate that to our financial plans, the math works, the historical data works, and all this does come together. It's just a matter of managing those expectations here in the shorter term, because that's where it gets a little bit challenging, right? And if you're reading the short-term headlines and trying to compare that to your long-term financial plan, well, there's a true disconnect, right? It makes you never want to be planning for the longer term, which is not the best scenario. So I guess as we wrap up, the emphasis I want to put here is make sure you're talking to your financial advisor about your financial plan, your investment allocation, because all these things matter now probably more than they ever have, which is why we're here. So please reach out to us with any questions you have. We will continue to do these roundtables as more questions arise, as the situations change, as all the economies, all the information is ever evolving, and we want to try to communicate that as best as we can. So with that, I'll wrap up. Thank you, Tyler and Mike here in Knoxville. Thank you, Nick in Chattanooga. And as always, thank you folks for tuning in and watching, and feel free to check in with us anytime with any questions. Take care.
Thanks, Roger.
Thanks.